Hello everyone and welcome to Fun with Fitzy. We are now on chapter 11, video 2. Now we're going to start getting into the journal entries for a merchandise company. Okay, so remember we're looking at the periodic inventory system instead of the perpetual. Okay, so in the periodic inventory system, merchandise inventory is kept in two accounts. The first one is merchandise inventory. This goes on the balance sheet. And it's a current asset, right? You know this from the last video. And there is also another account called purchases, and this goes on the income statement. Okay, merchandise inventory, there's going to be a beginning inventory and an ending inventory. Beginning inventory is what you start with at the beginning, and ending is what you have left after you do your physical inventory. Okay, so the merchant inventory balance shows the inventory at the beginning of the period. If you see a balance sheet and you see a merchandise inventory number, that's what they had at the beginning. Now at the end of the year, the physical inventory, when you count it, you value it at cost price to get your merchandise inventory number that we're going to use in our financial statements. So this would be the beginning inventory. This is going to be your ending inventory. At this point in time, the merchandise inventory count is adjusted to reflect the updated balance, and you're going to see this in the next section on worksheets for the merchandise company. Okay, let's look at when we purchase inventory. So when a company purchases merchandise during the fiscal period, we're going to collect it in the purchases account, not the merchandise inventory account. So the journal entry is going to be a debit to purchases, which is an expense. Of course, with tax, you're going to debit HST recoverable because you can recover this money back from the government. And then you're going to credit bank or accounts payable because you're going to owe the money. Okay? Don't get this confused. When you buy merchandise, debit purchases when you're using the periodic system. Now, this goes a little bit against what we've always been saying. When you buy a car, debit auto. When you buy supplies, debit supplies. When you buy equipment, debit equipment. But now I'm saying when you buy merchandise, debit purchases, not merchandise. You've got it? Good. Now let's talk about when we sell merchandise. So far we've been using the revenue account for a service company to collect the money that we charge for our services. For a merchandise company, we call our revenue account sales. So this is what we've sold. That's the ticket price, how much we've sold. So what does the journal entry look like? When you sell merchandise, debit bank, because bank goes up, or accounts receivable if they didn't pay you right away, and credit sales, and of course you have to pay tax. Okay, so debit bank, credit sales. Just like when you cut someone's hair in the past with the service company, debit bank, credit revenue. Same sort of idea. Okay, now let's talk about freight in, because freight in is really important. Merchandise companies have to pay to get their merchandise to them. And we're going to call this freight in. So freight in is an expense account, okay, that accumulates transportation charges on, now get this straight, incoming goods, not goods that we ship to our customers, but goods that we're bringing in. The freight in number is included in the calculation of cost of goods sold. You're going to see this. These costs are kept separate from the transportation charges for outgoing sold merchandise. Okay, I just said that. When you buy the merchandise and it comes in, use the freight in account. When you sell the merchandise, you're going to use the delivery expense account. Okay, so we saw this formula in the last video. Beginning inventory plus purchases minus ending inventory equals cost of goods sold. So I'm going to just slightly build on this as we go through this chapter. This is going to be our new cost of goods sold formula. Beginning inventory plus purchases, so it's the same. But when you purchase merchandise, you have to pay for freight. So we're going to add that freight cost here because it's going to add to the cost of getting that merchandise into our store. Okay, so that's the slight change. Less ending inventory equals cost of merchandise sold, cost of goods sold. Okay, beginning inventory plus purchases plus, that's a plus, don't get it wrong, freight in minus ending inventory equals cost of goods sold. Okay, by now you should know how to record purchases. You're going to debit purchases when you buy merchandise inventory. How to record sales, you're going to credit the sales account. It's a revenue account. And now the updated cost of goods sold formula that now includes freight in is beginning inventory plus purchases plus freight in minus ending inventory equals cost of goods sold. And know the difference between freight in and delivery expense. They're both expense accounts. This one tracks when you pay for merchandise to be delivered to you, and this one is when you pay for merchandise to be delivered to your customer. This one goes in the operating expense section. This one goes in the cost of goods sold section because it is now in this formula. Okay, thanks for watching. Hope this helps, and we'll see you next time on Fun with Fitzy.